the way the world's evolving, geopolitically, trade-wise, economically. I think we're in for some turbulent times ahead, and I think more and more countries are trying to be less dependent on the dollar. My speculation is that eventually this provision for insurance companies could go up, maybe 5%, maybe 10% in a few years, and it wouldn't be surprising because if you look back over 100 years, most central banks, they held like almost 90% of their assets were gold. So why shouldn't financial institutions also do so?
At the end of 2024, the dollar accounted for 58% of global foreign exchange reserves, while 10 years earlier, that share was 65%. Equally, the share of the US Treasury market owned by foreigners has also fallen sharply, from 50% in 2014 to around a third today. Gold's bull market began in 1999 at $252.50 per ounce. Over the past 26 years, gold has made higher lows and higher highs, experiencing periodic corrections. Even the most aggressive bull markets rarely move in straight lines. Financial expert Mario Innecco warns of turbulent times ahead due to weakening confidence not only in the US dollar but also in other fiat currencies. He notes that China and other nations in the global south have been steadily increasing their gold reserves for over 3 years. In February, China allowed insurers to allocate 1% of their assets to gold, and Innecco believes this could grow to 5 to 10% over time. A spokesperson for the Shanghai Gold Exchange observed, "The 1% requirement is just the starting point. We expect phased increases as insurance companies become more comfortable with gold as a strategic asset class." The insurance mandate represents the latest chapter in China's broader 2-decade strategy to diversify reserves away from US dollar-denominated assets. Since 2000, China has increased its official gold reserves from 395 tons to over 2,200 tons, although many analysts believe the actual holdings may be significantly higher, as some accounts are not officially reported to the IMF. Based on fundamentals, Innecco emphasizes weak demand at a recent 20-year US Treasury auction as a sign of bond market stress. He warns that Section 899 of a new bill could let the U.S. tax foreign holders of Treasury interest, risking global investor confidence. The One Big Beautiful Bill Act, which passed through the U.S. House of Representatives last week, includes the most sweeping changes to the tax treatment of foreign capital in the U.S. in decades under a provision known as Section 899. The bill still needs to gain the Senate's approval. Before we dive into Mario Innecco's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
I think it's like an expansion of what governments and central banks have been doing, especially China and the other global south nations. They've been increasing their net holdings of gold over the last 3.5 years. And I think now the Chinese are thinking, well, we need to get financial institutions to do the same. And I don't think they had any provisions for insurance companies. So they announced in February that they could have up to 1% of their assets in gold. And Elijah, the more I see the way the world's evolving, geopolitically, trade-wise, economically, I think we're in for some turbulent times ahead, and I think more and more countries are trying to be less dependent on the dollar. So this is just normal, and I speculated in this recent video because this is kind of old news, but my speculation is that eventually this provision for insurance companies could go up, maybe 5%, maybe 10% in a few years, and it wouldn't be surprising because if you look back over 100 years, most central banks, they held like almost 90% of their assets were gold. So why shouldn't financial institutions also do so? And yeah, that was the premise of my argument. It's not just the dollar that they're losing faith in. It will also be their own currencies because they've been a derivative of the dollar. But as for the bond market, yeah, there was a 20-year bond auction, I think last week, and demand wasn't great. The dealers, the primary dealers who work with the Fed, they had to step in to buy a little extra. Even the Fed stepped in. But I think, yeah, demand's still there. I mean, yesterday, I think they had a 7-year note auction, and then that went quite well. But as I spoke with you before we got on, there's a lot of talk now about a provision in the big beautiful bill. Well, it's a section in it, 899, and it talks. It gives the Treasury power to tax foreign investors, and some people are concerned that it could apply to US Treasury coupon or income, even though there's like an international understanding now that you shouldn't have withholding tax on interest income from government bonds. So I think that puts more uncertainty into treasuries. And after August, I think there's going to be like $7 trillion to roll over only this year of all the debt that has been accumulated and hasn't been able to be rolled over because of the debt ceiling. I think it's a huge problem. The technical picture for, let's say, the 10-year futures and the T-bond futures doesn't look very good. And personally, I've been saying since 2020, 21, even 2019, that I thought we were near the end of the bond bull market. And that's been the case since 2020. Yields have been rising. We've had some kind of consolidation since for the last year and a half, but we could very easily see yields spike again. Maybe that's what Trump and Powell were speaking about yesterday at the White House. I know Trump told him that he was wrong not to cut rates, but I had a look, Elijah, since the Fed cut rates last year in September by 50 basis points, they cut another 2 times by 25. And the 10-year yield is actually up almost 1 full percent. It was at around 360 when they started cutting, and it's now around 440. So I'm not sure if cutting rates is the solution. I'm not being partisan here. I'm just giving you the facts. But we're seeing a few weak numbers as well. We saw PCE today came in a little lower than expected, the core and the headline number, and we've seen jobless claims jump up to like 240. So maybe bonds will stabilize a little bit, but over the medium to long term, I think it would be a big problem for the Treasury, for refinancing and the cost of interest expense. Even Elon Musk came out the other day and said he's not impressed with the big, beautiful bill. He said you can't have a big and beautiful. You can only have one or the other. And since the administration started on January 20th, the dollar has dropped from like 109 on the dollar index to around 100 right now. So yeah, it has come off. And I mean, it's the Keynesian fallacy as well, that if you devalue, your exports will go up and it will cut the trade balance. But I've never seen a country around the world, and there are many examples of this, especially in the third world, countries that devalue and debase their currencies. They never become wealthy and export things, because a lot of times you also have to import like intermediate goods or commodities to produce the finished goods, the manufacturing goods in the US. So if your dollar is weak, it's going to cost more. And an example of a country that has not really had a policy of devaluation is like Switzerland, even though they've tried their best to keep the Swiss franc as weak as possible with no success, because it's still a strong currency. And they don't have such a bad history of devaluation, and it's a wealthy country. So that's the way I see it. And I think it is the policy of the Trump administration, a weaker dollar. And I think it will be particularly pronounced versus gold. But that doesn't mean to say, Elijah, that other countries are also not going to devalue versus gold. So it's going to be a race to the bottom. And that's why it's not just the dollar that's going down the drain. It's all of the fiat currencies.
In the interview, Mario Innecco states that inflation now affects consumer goods rather than just financial assets, making it more noticeable. He expects governments to manipulate CPI data and possibly impose ineffective price controls. He sees hyperinflation as more likely than deflation and urges individuals to protect themselves with gold, manageable debt, and strong community ties. Economic data reflects a growing pessimism, despite steady economic performance. Soft indicators such as consumer sentiment and inflation expectations have soured. Concerns about hyperinflation, geopolitical instability, and asset price volatility are driving demand for gold as a hedge against uncertainty. While some fears, such as global conflict, may be exaggerated, they underline a broader anxiety that shows no signs of dissipating. Global demand for gold bars reached 257 metric tons in the first quarter of 2025, marking a 13% year-over-year increase. Moreover, Innecco warns that rising Japanese yields are strengthening the yen, pressuring investors to unwind yen carry trades. This could spark a broader market sell-off. Let's get back to the interview.
We've had inflation for decades, if you look at the money supply, because that's the true definition. But I know what you mean, the CPI, that has gone up. And what was happening prior to 2022 is that every time the government and the central bank inflated the system fiscally and monetarily, all that credit and currency went into financial assets. This time, it came out of financial assets like stocks and bonds and went into consumer goods, and people feel it. And I think, yes, the government is how are they going to react? Well, they're going to tinker with the data. They're going to find new ways of revising the CPI, just like they've been doing since the 80s. If you look at Shadow Stats and John Williams, they've done it here in the UK in 2022. It chopped off like 1% off CPI. And the other thing they're going to do, I think, even if we have a Republican administration, they're going to bring in price controls. I think that's what Richard Nixon tried to do. And all of those things are going to fail. And people are not going to be happy. They're going to be more and more unhappy. Yes, you can try to get OPEC to produce a lot more oil and bring the oil price down, but that's not really bringing inflation down. It's just bringing oil prices down. So ultimately, I mean, the way to kill inflation would be to have a massive recession, massive Great Depression. That's the only way to eliminate a lot of that funny money that's been put onto the money supply over the last few decades, especially the last 15 years. So I don't see any politician, be it in the US or in Europe, wanting to do the right thing in terms of that, because the general public still expects Peter to pay Paul. As I mentioned the other day, Frederick Bastiat, he said that the state is the great fiction by which everyone wants to live at the expense of everyone else, and it still applies. We had a scare last August with the yen carry trade, and the yen carry trade is basically not just Japanese investors, but foreign investors borrowing very cheaply in yen and then taking the proceeds in dollars, euros, pounds, or Aussie dollars and buying high-yielding assets. And that's worked well the last couple of decades because the Japanese authorities, they've had a policy of keeping the yen weak and keeping rates at zero or negative. But now with rates all around the world going up, even though the Japanese central bank, the BOJ, is still doing I think $40 billion of QE every month, they haven't been able to keep their bond yields low. For example, the 40-year has gone from near zero or even negative 4 or 5 years ago to over 3% now. So what that does is that it makes the yen stronger because Japanese investors, they're bringing a lot of their funds home because they can get a higher yield in Japan. So that strengthens the yen. The people who have borrowed in yen, who did the carry trade, they're getting crucified on their borrowings in yen because the yen's going up in value and the cost of borrowing is going up. So what they do is they liquidate their higher yielding assets in the West and to close out that trade. And so the thing to do if you want to keep track of the Japanese yen carry trade is to see if the dollar is dropping a lot versus the yen. That's a bad sign. And also to see if the 10-year and the 40-year JGB yield, if they start going up and the yen starts going up, and that's bad. Right now it's kind of stabilized, but it could affect US financial markets, European financial markets, and it could have like a domino effect, contagion.
Since March, investors have been increasing their gold holdings, driven by concerns about the economy's health and market volatility. In the long term, Goldman Sachs research expects prices to be propelled by multi-year demand from central banks. As the dollar weakens and gold demand surges, could we be approaching a fundamental reset of the global monetary system? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.